Well, good day, ladies and gentlemen. Welcome to the second chapter, which is company ownership for finance and financial management, which is also called financial management, CT2 for actuarial science, financial reporting. So today we'll be talking about company's ownership, and in this chapter we will look at how company are set up and how they are financed, right? So let's start up with how companies are set up, which is different types of business entity. There are different types of business entity that you have to look at, such as a sole trader, partnership, common companies, limited liability, partnership. So let's start with a sole trader. A sole trader is a business, right, which is owned by only one person, in which is not a limited company. By saying that not a limited company means, which means that it has unlimited legal liability on the owner. The owner will be liable for any of the damages, or for any of the, if they sue him, if they sue the company, that means that they are suing the owner. He's not a company, by the way, sorry. So, and there is no specific legal documentation needed, but however, a sole trader will have to pay an income tax. So let's look at the partnership. A partnership is a company which is owned by more than two people, right? By two or more people, and it is also not a limited company. Means that there is unlimited legal liabilities to it. So owners may ownership of a company may vary, and they may have different percentages. Sometimes they may have equal percentages, but ownership can vary in terms of percentages. And they can also be sleeping partners, which sounds very wrong, but partner is just a partner who just contribute capital and does not and is not involved in day-to-day business. So individual partner may be sued for the entire death of the whole company. Sometimes one person in a company may be sued for the entire death of a whole company, but usually all of them, they will be sued and they'll be legally uh, liable for any of the sue that they sue, you know. So let's look at a company. A company has its own legal identity. Therefore, it means that owners of the company are not legally liable for any of they are not legally liable for anything. If there is any legal liability, it will be paid through the full value of the shares, right? And most owners and these companies is owned by shareholders, which buy shares, and then they will elect the board of directors when they allow you to vote for the board of directors. And this board of directors will then go ahead and employ managers. So board of directors just represent the owners of a company, because sometimes company can have thousands if not millions of shareholders. So we have they won't all be there involved in day-to-day businesses, so they have to elect a board of directors which will represent them. So a total dividend is paid to the shareholders, and sometimes this total dividend may be the same as the profit generated, and sometimes even less, or sometimes even more. And when it's less, it is called retained earning, which is the money which is left for these companies, for the owners. And when it's more, it means that it means that the company has made enough retained earning that it can pay even more than the profit which has been generated after in that certain year. So, and then we have a limited liability partnership, which is just the same as a partnership, except that there is a difference that this business has its own legal identity from its owner, right? And they may be having documentation such as partnership agreement. So this is just the first chapter, the first topic in the second chapter. So there are still other videos to come for other topics in still chapter 1. Thank you.